Joshua Oigara CEO KCB, pleasure to be speaking with you today.
Thank you, Alikan.
Came yesterday to the half-year earnings release and just wanted to first of all talk through those numbers. Firstly, Joshua, there was a small decline in total group assets, right, of about 1.17%. My analysis was that this was really a rebasing of South Sudan, and that's what led it. Would you just tell us just about that headline number, how you saw it?
So obviously we look at what is the growth on the actual overall loans for our business for the group at 8% and for Kenya business at 11% on year, which for me is a strong growth. And we over the year last year in December specific, there was a technical review on the currency for South Sudan against the US dollar. So we moved from what they call a fixed rate to more of a variable rate. So effectively we are revaluing the assets on a different kind of basis. And for you to see like to like, from last year, our businesses overall assets will be up by 14% if you look at it from a year-on-year basis without the devaluation. But now we're in a new regime, which I think is the right regime, allow the currency to float. And the country is doing dramatic amount of work to support this currency. You need to build foreign currency reserves. The country has got a lot of oil reserves, there's no doubt. And and they have credit facilities already organized with the IMF and the World Bank to support. It's just that the facility has not been dispersed over a period of time. And so in our view, it's more of a technical evaluation as you look at the numbers last year and this year. And the 70% reduction on assets is perhaps just putting our assets in the right picture in South Sudan. And much of that is now done. Our loans were roughly 6 billion in December. They're now 1 billion in South Sudan, which is not a big amount.
No, not at all.
95% of our business is much more fees and commission and transactions. And as that picks up, I tend to see that South Sudan gives us a completely new opportunity. For an economy like Kenya, where we've midwifed and negotiated the peace agreement a couple of years ago in 2005 and 6. And whereas we see Kenyan businesses being nervous around South Sudan, I see it very opposite. I see that Kenya should be in the forefront of taking the real opportunity to catalyze growth in that market. And over time, we'll be proven right. Because we see that in economies where you go early enough and invest, I believe you have a chance to reap the greatest benefits. So we're becoming a catalyst in that market. Time will tell.
It was interesting what you were saying, that it's much more transactional now. You've reduced the loan book, so you've repositioned, you're confident and then you were mentioning yesterday that the UN was using you as a conduit to reach, because you're very committed to South Sudan, Joshua. You're in every, what do they call them, in every county? Or
our kind of business in South Sudan, Alikan, is more of a long-term business. I don't think you can run business in this kind of markets in Africa having a short-term view. So long-term would mean it's a 10 years, a 20-year business. And also I'm very excited about the role that the United Nations does in South Sudan. There's a lot of partnership from the United Nations. There's a lot of work from the United States, US. And what we believe is that the little issues will be addressed. The disagreement among the new leaders. It's not unique in an African country that this problem arises. What is important is how are you addressing, either through IGAD, the Great Lakes, the UN, how do you use all these bodies together to find a political solution to the problem?
And you feel confident there is a path?
And I've spoken to a lot of people, our own delegation from Kenya into South Sudan, the Intergovernmental Authority on Development, and what we see is that they are confident. And two aspects are happening in South Sudan. So one is that all these states are running their own businesses with their own. I love that the country is now building non-oil revenues as a platform of building their own growth. And a year, 2 years ago, it was 98% of their revenues coming from oil. When you look at it now, it's more or less like 60% is oil. So they're dramatically shifting their revenue base.
That's incredible. People seem to have missed that.
Bringing in new taxes, bringing in your own customs at the border, bringing in some VATs. This is really, and for an economy of that nature, it's quite easy to build a 50-50 basis of revenue collections in 5 years. And that starts building new businesses, new entrepreneurship. So we see a different story ourselves. Granted, there's a devaluation of a currency, but over time, every single currency globally, which is being pegged to the dollar, does devalue itself to compare with the markets. So I would say, yes, 1% reduction on assets, but overall 11% growth in earnings, in loans in Kenya, and 8% for the group.
Yes. So, okay, so if I can just stay with the regional picture, because obviously, I mean, I looked at full year 2014, South Sudan was something like 10%. It's now 8%, and today it's what would
4%.
4%. So,
Correct.
so that explains why that
Correct.
asset number. If I can go to the other regional countries, because your chairman also made some comments saying it was quite tough, and he bundled together South Sudan, Burundi.
Correct.
And I think he was also saying Uganda had been slow as well. Is that correct?
Correct.
Do you want to just give us a bit of a picture on that as well?
So, I mean, for us, we see opportunities across East Africa naturally. Over time, will become a common market. There are concerns around, barriers of trade, or what you call the non-tariff barriers. But for me, what excites me is that if you look at the centricity of the values of the people, especially the younger generation in the region, you see that we are more aligned about the businesses. If you find a young person in Kampala or in Kigali, or today, they're looking at the same kind of challenge. You have a lot of people doing businesses across, techies, new businesses, construction. You find that running businesses, hospitality. So what we see is that we've gone through a period of elections, general elections in Uganda. Yeah, there was a referendum in Rwanda. There was elections in Tanzania. There was kind of election planned in South Sudan.
Yes.
And Kenya and Rwanda will become the next year in terms of doing the general elections. So I don't see that as a difficulty. It's a transition. I see it as a temporary blip in the markets in an election year. And over time, that will take off. So what we like to build on our businesses is to take opportunity, be aligned to take opportunity in those markets and strengthen our businesses. That's what the goal is. Absolutely. We want to take advantage of those markets. Burundi has been, we see some stability coming into Burundi now. Rwanda has been perhaps one of the best performing businesses for us and economies in the region. We see a new leadership, in Tanzania.
Yes.
So if I speak about the story of the region, we are very committed as a business to building synergy at the regional businesses, even as the custom union becomes reality in the next few years. This is the time to plant the seed that will build the value for our investors in the region as things stabilize, and they will stabilize.
Yes. Okay. So
and the cost of getting out of those markets and re-entering will be extremely expensive
worth
for
it,
that.
is it? Yeah.
Absolutely. We've already made the huge investment in these markets. And what we see is that in the next 2 years, is even with the natural reduction of our South Sudan in terms of the valuations,
yes.
What is important, Alican, is to look at our real local currency business in South Sudan, growing by 50% on a year-on-year basis.
Well, I was amazed because I think it was Lawrence who said that you had made more money in local currency in the first half than you had made entirely in the full year.
Absolutely.
So I think now that you've rebased it, you should see some quite juicy numbers coming out of these.
So the region is great for us, and I mean, if we compare what Uganda does for an economy like Kenya, it's the single largest export partner for us. Yeah, so this is where we need to build our own strategy for what is a trade partnership strategy for the country, and how do we anchor ourselves as KCB to take advantage of those flows. How you look at it, the region is the biggest trading partner for our economy. And because you're a natural hub as Kenya, the issue is for us to position to exploit that opportunity as a business.
I think you're the only one positioned in all these places, right? Let me just then go back to the core franchise, which is Kenya, which when I looked through the numbers was the outperforming component, wasn't it? I think the numbers were plus in Kenya. You were about 500 basis points higher than the group. Do you want to just tell us where all this strength came?
So it's been very exciting for us in Kenya. I would say three main reasons. I mean, our market share overall in terms of total asset is up 150 basis points in December and now. So that's quite an exciting move. And it's driven by, one, I would say, our partnerships with Safaricom. So we brought in a number of our customers, nearly now 6.5 million on our mobile platform, taking our total customers to 12 million. This is the highest we've ever been. If you compare our 2 million customers in 2012, I mean, that's six-fold increase in our customers. So but all of it happened in 1 year.
You've gained more customers in a couple of years than you had for the entire...
Absolutely. So that has brought in into a new, nearly... Today we've crossed 11 billion shillings of lending to this kind of customers. If you see the value of engaging and having transactions, building a digital platform for our bank, so that journey is growing. So we started last year. It's a 3-year journey. So we ring fence and build on that business model. It's the most exciting business for us. Perhaps we foresee that half of our business by 2020, which is the next 4 years, will actually be the digital side of the bank.
Wow.
So that's one side.
But you have understood that from a long time, Joshua. Ever since I've known you, you've embraced that whole digital banking.
Correct.
And I think what you're seeing now is the fruits of appreciating what was coming, right?
Absolutely. And we're having a lot of excitement, a lot of partners. You know, we're working with McKinsey, for instance,
Yes.
to be able to build up, you know, our digital bank, our digital institutions. Where do we want to go ahead as an organization? So that's one side of it. Number two, Kenya has been able to really expand its business across many channels. You know, if you look at the asset side, you know,
Yes.
being able to build and strengthen our businesses. So now in terms of SME growth, we've seen that growing by 40% on a year-on-year basis for our business. And also we benefited Kenya for the, I would say, flight to quality. If you look
Yes.
at our kind of deposit, they're up nearly 18% compared to the same time year-on-year,
Yes.
but just for the Kenyan business. And we've seen that as a way of customers saying, we want to ring-fence our deposits. For us, is how whether we can get our money back
Yes.
as an organization.
Yes.
And that is an exciting mark for a business which has been long enough, stability, strength, long-termism. That for us is what we see as customers are looking for.
So can we just touch on that? Because you made the comment saying people are not worried about the interest rate anymore. They're
Correct.
worried about getting their principal back.
Correct.
We've seen this deposit flight to quality, which has helped KCB, has it's
Correct.
been supportive.
Correct.
What's been going on in the banking sector, and how are you positioned in that sense?
So the market has seen last year and early this year has been very perhaps the most difficult years in the banking sector over 2 decades.
Yes.
So we saw this problem in 1993, 94. And over time, what tends to happen is the difficulties we see in the industry are not something that is new. We've seen this before. Yeah, but I always say that in the long run, you know, investors and depositors need to look just beyond what is the highest interest rate I'm paying in the market. Business and banking cannot just be about getting the highest interest rate. It must be about what is the purpose of the organizations, what investments are we making in the community, and how are we scaling our business for long-term sustainability. That's the three things that business should be looking for. We're going to deliver profits, definitely. We're going to work with our people, and we want to be able to generate some value to the planet. That's the three kind of P's that we work with as an organization. So we see a change.
Yeah.
You know, customers getting nervous. I must say in the last 3 months, which is the last quarter, with our spending significant amount of our businesses to support Chase Bank,
Yes.
we brought some kind of stability in the industry. That was a big move that was to kind of say the market was a little bit lopsided, we are now building stability.
Yeah.
And KCB used all its capital to invest in terms of resources to say let's kind of build the industry on a stable platform. And for us, we don't think that the industry is out of the woods yet. Correct? There's a new normal coming up. Customers looking at recalibrating where should we put our deposits. Granted, the two banks which have closed is nearly 160 billion shillings of deposits, and that's a significant amount for the industry. I mean, for deposits which are 3 trillion shillings, losing 160 billion is not a small feat.
No.
So it's to find a resolution, and we are clear that Chase will be resolved earlier than the 1 year which central bank had set up. For us as KCB, we are prepared to take advantage of our customer centricity, our network that we do have, our deposit franchise growth. And also, we haven't been a bank that delivers the highest interest rates, both to depositors. We have been a fairly competitive bank. So we deliver fairly good interest rates for our customers who are coming to us with other products, and also to be able to say we are not paying the highest interest in the market. So that's the balance that we have been playing and pushing our digital financial services ahead in the next year.
Let me just go back to Chase Bank, because you said yesterday that your work is done. I think that's to quote you, and that it was now going to be a job for KPMG, CBK, and KDIC to find a potential investor in there. That decision to enter there, was that driven by the national interest, by the fact that you are a big bank and that you were playing a role in there? Because there seemed to be a lot of propaganda about that whole intervention. And by that I mean, people were saying you're buying it on the cheap. And just tell us, Joshua, what exactly drove you to go in there, and what's happening now?
On the 26th of April, which is nearly 100 days ago, I tweeted a message to Chase Bank and said, go Chasers, it can be done.
Yes, I saw
you
that.
can go back and rebuild a greater organization than your past. And the specific reason why we went to Chase Bank was really to push the agenda of stabilizing the financial sector. Because we see the opportunity and we saw the risk. There was concerns around this is a systemic problem facing the industry. And Alikan, this has been issues in other countries before. And suddenly you need successful banks failing, and suddenly all of us, even as large banks, are part of the contagion. So the reality of the matter is we could have done it. It was not just KCB's proposal.
Yes.
NIC Bank had the same kind of proposal to the central bank. And we said, because in our view it was a short-term mission, without an investment, we will be able to bring in Chase Bank into operational. That's one aspect why we went in there.
And it is now.
And we did believe that although the bank was kind of not was closed, we would then get it back into its feet, get it running, have its doors open. The second phase, which was much more the most important one, was getting the central bank to do a business review with an independent party. And now we've appointed, the central bank has appointed KPMG from South Africa to do the work. And that will then define the future of Chase Bank. So we just remain an interested party. The concerns that we are conflicted was, I believe, lack of clarity, that we will be involved in doing due diligence and building information. We didn't spend time looking at Chase Bank's books. We focused on opening branches, focused about getting the systems back, getting customers access, getting information, being able to reopen correspondent banking relationships, being able to get Chase Mfukoni working, getting all the staff across the 62 branches aligned and engaged. I mean, in 3 months, that's a dramatic amount of work to do. Yeah. And that has been completed. In my view, initially we were given a year, but in 60 days, that work was completed. So where we are today is very historic as well, Alikan. If you look at the chapter of our country, never before has any bank been reopened and kept open. So we're kind of writing a new chapter in the book, in the history of our country. This is the role that we have played. Now, to do that, sometimes so KCB prides ourselves about looking beyond the short term, and we kind of run a long-term race, which is a marathon. In the short term, the concerns that KCB was buying Chase Bank is actually not factual. We like a business process that it is transparent, above board, and we may not be the one that offers the best piece of investment for the shareholders, but that is not for us to decide. That is the shareholders and central bank to decide. And there are many other people, in the past, people say there are many people interested. What you've done is to get the bank into its feet. The staff are there, the engagement is there, the customers are in there. And we do believe that KDIC and central bank will do the very best to make the process transparent. Now, Alkan, if the process is not as transparent and open, we will not participate.
Yes.
And we made that extremely clear to the central bank.
Excellent. And thanks for clearing that up, because I think there's been a lot of noise around that.
Yeah. And Chase by itself is a great brand.
Yes. What amazed me, Joshua, was the brand strength, actually. Yeah, I remember, at the time before you intervened, and the amount of support all these customers were giving the bank, it was sort of some kind of Kool-Aid that
and
they had.
Ultimately, what destroys a big brand is the trust and integrity of an organization. No matter how strong you are, little things, it reminds me of the old days of Enron many years ago. Yes. Little aspects about governance can destroy even the strongest organization. So what we see ourselves is that Chase Bank has a very strong future. It's not the bank that should be allowed to disappear from the face of our country. It has got a very centric customer engagement that runs, it has, and when we looked at Chase Bank's process themselves, it had very good policies, I would say, were world class. Yeah.
So what went wrong?
So that's an issue that central bank still has to continue finding out. So the realm of central bank to determine. So they've done some detailed investigations, and also, the independent business review kind of company will also assess your assets, your books, your loans, and look at your legal aspect. Where are we? So from our point of view, we are extremely excited that we've been involved to bring back an enterprise that had collapsed. Yeah, and ring-fence the depositors' balances within this fund, because there had no chance, Alikan, of getting the money back.
Yes.
Absolutely.
There isn't.
There wasn't any chance until we intervened.
Yes.
There was no other alternative. Right? You just need to look at all cases of banks which have closed in the past.
Yes, there's been no record of one that I can remember being rehabilitated like this, like you've done here. Am I wrong?
So when we say that our work is done, just to be clear, so we had a number of staff in Chase Bank, and as we reduce them by 50% this month and next month, we are saying that if even KCB was to invest in Chase, we don't need our staff in Chase Bank. Chase already has got his own. Maybe you just require a managing director in Chase Bank. You don't need to be taking up all your people and put them in another organization. So that's where we're saying that ultimately you don't need as much people in the future, whoever the investor is. And that is preparing the bank to getting out of receivership. And we believe it's a question that the central bank will resolve. The responsibility for the future of Chase is not in KCB's hands, it's in the hands of the Central Bank of Kenya. That should be extremely clear. It's the governor and the KDIC that have the legal mandate to determine the future of Chase Bank. And for us, what we're doing with this process is to hand over that responsibility, hand over cheers, technically, to central bank.
Can I loop back now to the results again? You were speaking about rescheduling the rights issue. You were speaking about doing some debt.
Correct.
Can you just tell us a little bit about that? Because I think that was hanging on the price a little, right?
Correct.
You know,
Correct.
people were getting concerned that there was going to be extra supply of shares, and now you've removed that. I think, you know, that's why we're seeing a positive reaction as well. If you can just tell us what's happening there.
So if I look at our capital plan, so if I start back, generally banks assess themselves using what you call an internal capital assessment process, or ICAP, which is a very globally Basel III process for us to look at our capital. We're among only the 2 banks which have now adopted that from 2015 in December. So you will assess where you are in terms of your total capital requirements. And in a bank, we tend to look at your core capital, which is usually your tier 1 capital, and then you look at your total capital, which includes supplementary capital. So last year, our goal for speaking to our shareholders was to say, we are going first to raise debt. And it was a very straightforward process. We said we'll raise $150 million of debt. And then we'll come back and look at raising the rights issue of $100 million. Yeah, we said up to a maximum of $100 million. Correct? Because at the end of the day, we had the script issue running. And at the script issue, we intended to raise close to 3 billion shillings or so. So the process has been ongoing. We've now been able to get formal commitments on our, basically we raise it's a loan program for our debt capital. It's not, we're not going in for one specific bullet. So we have commitments for close to $200 million. We will deal with $75 million this year. And that's sufficient enough in terms of taking our capital structure correctly where we want it to be. So our buffer is around about 200 to 250 basis points above the minimum requirement for central bank. And that's where we want to be.
And that's sufficient. And that's probably optimal utilization as well, right?
We don't want to have too much capital than we require. Yeah. In terms of tier 1, we are very clear today that with strengthening of our cash generation from our main business, largely the Kenya business in the last 6 months, and the next 6 months, then we have sufficient headroom on capital. We appraise our capital every single quarter. Then, and because rights issues are a process we need to run for 90 days, we say we reschedule it. We have sufficient capital today. We have under no pressure to be able to increase capital because we are now well funded from a debt capital point of view. And that is the message that we are sending to the market today. I mean, in the future, and we are open enough to be flexible. That for me is the message we need to be able to say to our investors and to our shareholders, to say, look, we looked at this is where we're going, we have what extra cash we need. The greatest news to shareholders is that the bank is not coming back to you to raise additional capital.
No, and I think that will be like a very positive sign for the stock price.
In the long run, we say, what we have always said is that if KCB and our shareholders are always aware that should we have a specific opportunity to dramatically grow our business through an investment or acquisition, then we have a specific conversation with our investors. How do we fund it? But that is not on the cards today.
Is there anything on the horizon in terms of
this year, next year, our focus on consolidation?
Consolidation.
Correct.
You're not beating a path into the DRC or Somalia or any of these other
destinations?
No,
not this. Yeah. We've looked at a lot of opportunities in the DRC. You know, we spoke a while back with the BIAC, which is one of the large banks in the DRC. We talked to a number of institutions in Somalia. So those we don't see. We need to be in a market that we fully understand. And in the next 2 years, our goal is to consolidate and strengthen our existing businesses in Uganda, in Rwanda, in Tanzania, in South Sudan, in Kenya, and in Burundi, and growing up a little bit our entity that is in Ethiopia.
Yes, that's definitely on your radar, right?
Exactly.
Yeah,
exactly.
And you see that as opening up.
We see that as a fantastic opportunity for ourselves. Speaking, and there is a concern around when does the market open.
Yes.
But today we are doing a number of trade financing deals with a number of banks today as we speak in Ethiopia. We are looking at building a correspondent banking relationship, being a center of choice for banks in Ethiopia today. Today they are relying on banks in Europe or in South Africa. You know, we are much nearer today and understand the business profile for the region. So that's where we start in terms of building our business in Ethiopia. The next, when they reopen up the market, is one thing to be in the market already, understanding how the market operates. And that's for us, and it's not a very expensive investment. Generally, in this market, remember the license fee is nothing less than $100,000. That's all.
Wow. So it's an optionality for you.
Absolutely.
Returning back to the results, there are a bunch of things I wanted to talk to you about. I mean, cost to income ratio. You've wrestled that below 50%. I remember for a long time, Joshua, because I've been following the bank since 2008, it was at one point, it was above 60%. 64%. Do you remember that, the peak? So you brought it down very dramatically. Is this you making an impact on the operational side of the bank? How much further can you take that down?
I mean, I do believe, Alikan, that banks still in this region are still expensive in terms of the cost of operations. And if you think about the next 3 to 4 years, our cost to income ratio should be around about 40%. Because as we move more and more into agency and mobile and using those two channels.
Because I saw you that 2/3 of your transactions are now outside the branch, right?
Exactly.
Is that going to continue in that direction?
We do believe that it's an 80-20 rule, that 80% of our transactions are going to run on a digital platform and 20% transactions will run on our branches. And that today, already more than 80% of our transactions are happening out of the branch. What the synergy we are going to do between this year and next year is to bring in, monetize those channels.
Yes.
So it's also to move the revenue shift. So that today we are 30% of income is coming from digital channels than 60%. And we want to move more than 50% of our income to come from our digital channels.
Wow.
And that is on our mobile, strengthening and deepening our relationship with our KCB M-Pesa, which for us is an exciting investment for last year.
Yes.
And also being able to expand the regional services and regional entities on a digital platform, largely payments, savings, loans. If that happens, account opening processes today, using that to make payments as you go to your retail store, you go to a convenience store. If that happens, and that is where we're pushing so much on our digital bank, this is the new way of pushing the value, because the transactions are already there. And not all transactions can be monetized. And as we think broad about what KBA is doing today, the Kenya Bankers Association, so what you call the KITS, or the Kenya Integrated Switch, which is coming on board, will actually bring in a new platform for all the banks to connect all their customers' profile and transactions on a mobile platform. So that's going to give us a new opportunity for banks which are mobile ready to be able to enable settlement, transfers, payments. You just need to look at a few figures last year, Alikan, just that gives you the potential of opportunity. Total transactions or payments last year, or money transfer, if I use that term, was around about 33 trillion shillings in the industry. So both banks and money transfers by mobile companies. So if you look at the largest one, which is M-Pesa, roughly 3 trillion shillings was the transactions last year. Banks' transactions on payments were 30 trillion shillings last year.
Wow.
But it's a very inefficient, very traditional. So basically, these transactions are being done through the real-time gross settlement, which is the RTGS switch, or they're being done by the banker switch, which is the checks. So the clearinghouse. That is a very archaic, in my view, old way of making transactions. So if you can assume to move 15 trillion in the next 2 years into the banking mobile platform, which is through the switch, you can imagine how much more potential of revenue that the banks will create in the next 2 to 3 years.
Goodness. Yesterday I was at this presentation by McKinsey about digital, it was the East African Digital Summit, and what they were saying is that, it's a lot to do with culture, this sort of new economy, e-commerce, digital. How did you deal with the culture issue? Have you created, they were saying that in one organization, someone had set up an entirely separate digital division and said, you can challenge us as your parent company. Was it a cultural issue, or was there anything like that you had to sort of ring fence, or did you find that digital champions just grew in the business? How did it happen?
I mean, for KCB, our business, we've been in a unique position because we've already built partnerships with a number of digital organizations for the last 3 to 4 years. So if you look at our partnership with Safaricom, for instance, it didn't start just with KCB M-Pesa. We're already working with KCB, with Safaricom from a long time. We worked with a number of agencies today to build our payment platforms today. Whether we're working with MasterCard International or Visa to say, how do you make settlement today somewhere that we see much more as a digital payment platform than carrying cash? We've been speaking very strongly on transport sector. So what we did find is that we had got elements within the organization that were much more ready. I would say that the wind of change was already blowing in the market. And much more important, we have got, today, if you look at a number of staff, nearly 60% of our staff are below the age of 30.
Wow.
Their natural way of life
Yes.
is building conveniency around a digital platform. You just need to look at it, how they communicate, where they go to party, where they're going for a restaurant, where they go to school, where they live, how they share information. That is their kind of way of life. So Kenya has been pushed a little bit ahead because of the nature of the market. So today, I believe that if we are not moving our businesses to a platform which is digital, we lose the relevance for our customers on a daily basis. Yeah, and I've some of my staff, when I walk around, and I may not carry money with myself, but I get everything done no matter where I go in this country.
Yes.
Yeah, whether I'm carrying my mobile or I'm carrying out my card with me. And these are the things that get you moving. So as you progress, our role now is to centralize or to be able to consolidate all our digital platforms into one organization. That's what, and this is what I believe McKinsey was speaking about. If there's one place globally to exploit digital banking and provide real innovation, Kenya must be that epicenter for the world. Right. I'm not aware of any country, any region, any market where this vision can be realized today with a neck-breaking speed we've never seen before. So we are in the right moment today about the change. We are seeing where it's happening, it's historic, and for our business, I believe the next 2 to 3 years will be the most exciting. Now we see that transformation, dropping our efficiency in terms of cost of funds, reaching more customers, so enhancing reach and financial deepening, and finally being able to grow our ROE for our customers because we are much more efficient as an organization. So the costs will definitely come down. But it will come down not because costs themselves are dropping, but because your revenue base, in terms of the transactions,
it's increasing.
It's the customers that you can bring into the pool, the platforms that you engage is increasing. And our belief as a bank is to build on the partnerships with like-minded organizations to exploit the opportunity. For too long, we are fighting to split the pie in the market. I do believe that the chance is to grow the market to a new normal that didn't exist before.
Going back to the results, Joshua, can we just talk through the situation around NPLs, around provisioning?
Correct.
Obviously, there's a lot more scrutiny under the new leadership at the central bank. I saw a number of developments on that front, but there seemed to me a little bit of confusion about provisioning in Kenya and then provisioning at the group level. Would you just like to tell us, from your perspective, first of all, you were talking about this move higher, but saying by the end of the year you expected the NPLs to have improved. You were saying look through the customer, it's actually a government issue, slow payment issue in Kenya.
I mean, I would say that just broadly looking outside where the industry is, Alican, last year was a much more difficult year for a number of corporate organizations in the market. It was a year that we had one of the largest profit warnings by institutions listed in the Federal Securities Exchange. We had difficulties of organizations facing delays in payments. So generally we had some difficulties last year at the macroeconomic level. When that tends to happen coupled with higher interest rates, which is a temporary spike in September and October, you see a weakness in terms of delayed in payments. And for banks, it translates into non-performing loans. Because naturally, if you're in arrears after 90 days, then you're classified as a non-performing loan. And that's really the context of the markets. I mean, it will be quite rare to see those conditions happening and not seeing us an increase. So I wouldn't say that the regulators has changed. The guidelines are still the same. There has not been any additional scrutiny that we've seen from the regulator. What has happened is that the market delay in payments of contractors, some delay in the payments for suppliers, that is what has and it does happen. So for us, we've had 2 to 3 clients where we've had some delays in payments since the first quarter of the year. And I'm happy to see that there's dramatic progress to get them done, to get the payments rescheduled, and that should get us back. Our main business, retail banking business, which is now half of the group, the non-performing loan ratio is at 2%.
Goodness.
Yeah, 2%.
That's excellent.
Yeah. So where we really see the issue ourselves is around our large corporate segment, where our NPL ratio today is around about 12%. Traditionally, it used to be at 1% or 0.5% in 2012 and 13.
That's interesting, isn't it?
Because these are the best businesses, correct? But when you look at their own profile, that is where we are addressing the issue as an organization. Now, and therefore, as that has increased in Kenya, our own provisions for Kenya have increased by 22% on a year-on-year basis. So the bank is moving towards, that's for me is what I like to clarify. So we will continue taking higher provisions to be able to make sure that as the debts get recovered, that provision is written back to income. So we have a huge opportunity. We expect to recover nearly 3 billion shillings of those loans in the second half of the year.
Actually, I met your head of Kenya before I came in here, and he was saying this could be a very strong year if we get that recovery through, which he was confident about.
Absolutely. So this is, and then at the group level last year, we had made some specific provisions higher, and those kind of assets have been recovered in the first 6 months from last year. So you're looking at a year ago.
Yes.
And so for the reduction of 20% was largely in South Sudan, and and also in Tanzania. And that, in my view, was because they're not a huge part in terms of the group. We don't have any additional weaknesses at the group level. So I would say it's a difficult environment for the market. We will see some weakening in terms of the provisions. But with the rates now which have come down, and the government making strong commitments on making payments, we believe that the second half will be very strong in terms of reduction of provisions for the oil industry, and KCB will be one of the biggest. So we are committed to delivering our 6% or 6.5% by December, and that's going to be reality.
Let me come back to the interest rate saga, because this is front and center. We've got this bill that was passed by Parliament, which I'd ask you to talk on, but if I can just go back to what we saw. Obviously, we had this surge in October.
Correct.
T-bill rates went above 20%, to one-year T-bill rate
24%.
24%. Probably the trade of the year last year, I think.
Correct.
Now, and we saw that also in 2011. Now,
Correct.
My experience when that's happened is that actually the whole market reprices.
Correct.
There's more, you got to pay up for deposits. Would you say that, and then you get this normalization happening. Would you say right now we're in a process of normalization to lower interest rates? How would you describe the interest rate environment that's led to this pressure in Parliament and that's led to this sort of interest rate cap bill? And how are you dealing with it as an organization? Is it a good idea? Is it a bad idea? And, when I picked up finally on one point you said that the KBRR is not a good transmission mechanism.
Correct.
And I thought to myself, really the one-year T-bill should be the transmission mechanism, because that's where the whole market seems to price off. What's happening?
I mean, for us, we see the KBRR as one step. A reduction of interest rates as a regime in a whole economy, in my view, requires more stakeholders and more engagement. I do not see a magic hand that comes in, because the elements that drives interest rates, you're going to look at what is your expenditure plan on your fiscal side, what is your revenue collection that you have, what is your deficit, your current account deficit at the economy level, where is inflation, and what is the exchange rate. You're going to look at all those components. Which sector, where is the economy performing, where is the GDP expansion happening? When you look at all those components, then you put together, it's more like a crystal ball. And the curve that brings down the normal rates is not a perfect normal curve. Where the interest rates went up last year in October, and we expect that by December, January, they've come back to zero. It's a much more elongated normal curve if you think about your standard 3 deviations on the normal curve. So rates went up to 23, 24% in December. Actually, in November, they were 19%, 19.7 in December. They've come down, and now we are around about 18% as an industry. Before this, the rates were at 15%.
That's right.
Correct. So, and now banks have also adjusted their rates in the month of August by another 100 basis points. So technically, today we are at 17%. So the difference between 17 and 15 is not the difference between 22 and 15%. So banks have actually come down 500 basis points in the last 8-9 months. So we believe that there is good reason and opportunity to engage with all the stakeholders, largely the National Treasury, the Central Bank, the banking sector, and the National Assembly, to find the solution for how do we deal with the bottlenecks that increase interest rates. And we've addressed these 3 issues. How do you look at your cost of deposit? And in my view, the KBRL is not the reference. The CBR is not the reference. Your treasury bill rate, 91-day, is the reference point for the cost of funding for banks. So we need to look at this instrument and see some adjustments will need to be made to the reference rate. This is one aspect in terms of the equation. Number 2 is to look at your non-performing loans in the industry. Today we are quite high at almost 8% at the industry level. So how do we isolate so that good payers don't pay the price for bad payers? Because if you look at it, there are customers who should be borrowing at 10%, TB plus 1, and the customer should be borrowing at 30%. because that is the way the risk profile, or people should be excluded from lending because they're just bad payers. There is no value in a bank giving money to someone where the probability of default is 100%.
So tell me what happens in the event that an interest rate cap, because not everybody is at that ceiling, are they? And if you look, I mean, at some pretty disastrous scenarios where people have tried this, Joshua.
Yes.
You know, look at Venezuela, where you ultimately get credit rationing, you get a seizing up of the entire banking system. I mean, I know that's a dystopian future, but isn't it something we've got to be careful about?
I mean, the consequences are extremely severe. You know, and when I speak to my customers every day, and you know, today it looks like the debate is between the parliament and the financial sector. But we have customers that come to the bank every day and say, for me, I know my credit score is not very good. I'm prepared to improve it, but give me some access to credit. So basically, you refinance and restructure a bad customer to make him a good customer. It takes time. And so we also have a real engagement with our own clients and the industry. And as KCB, we are very clearly engaged on what customers are looking for. So that segment of high-risk customers would be technically excluded. But they need their funding for their businesses, the micro enterprises, the border individual who is setting up. He has no security. Your check loans which have unsecured loans, the banks will not be able to lend to that sector. So, and let's also see that their customers today borrowing at 11%, 12%. You know, what happens to them? To their pricing gets increased to the 14.5%. So I see in my view that there is great opportunity. The consequences are huge, but we haven't exhausted the opportunities to find a working solution for the interest rates. And we're very open. The KBA has proposed 3 mechanisms, looking at the treasury bill rate as one of the basis of benchmarking loans in the market, especially for short-term loans. The second item is to look at how do we build a specific SME fund that targets women, young people, the micro loans in here, and price them at around about 14-15%. Now, a 30 billion fund, which is revolving short-term loans 6 months, 1 year, will almost reduce our interest rates overall by another 100 basis points. So that gives you back to 16%. And for me, 16 and 15 is very close. And thirdly, we then look at the profile of a customer, risk profile.
Yes.
And depending on where you are as a customer, you then can go to your bank and say, I want to be the best price. So if you look at the credit information that's available from the CRBs, we like to push for one thing we do agree, and I do agree with the bill before which has been approved by Parliament, is transparency of pricing by banks. So I am a strong believer that if you walk into the bank and you can see your exchange rate for all the currencies, you should equivalently see the ruling interest rate average for the entire that bank, for that branch, so that customers can walk in from one branch and out. An interest rate itself, of average for the industry, is not a secret. It's something that we should disclose. So the annual percentage rate that KBA has been pushing for is a reality. So I would say it's not the way to go. And other than burning the house to kill the snake, what we should aim to do is to go in there and identify the mechanisms to address high interest rates. And we should reduce them. It's not the first country to reduce interest rates through a concerted effort. So I am positive.
Do you think the financial sector is going to come up with a response in time?
Yes, we have delivered responses already to the National Treasury and the Central Bank. And they are very it's not that we have not provided responses even to the members of Parliament. We have engaged the Committee of Finance Trade for almost a year with proposals. We like to see that process carry on. And the solution will still be us engaging further with Parliament through the National Treasury to find a middle ground on this issue. Alikani, if the bill is passed into law, the consequences for the Kenyan economy will be catastrophic. We are a large payer of taxes. We support funding to huge sectors for the economy today: agriculture, hospitality, education. If that doesn't exist, SME and micro enterprises, you start then seeing an impact on Kenya's gross domestic product, the GDP growth, getting impacted.
So you feel confident that the president will not sign this bill?
I mean, I'm confident that banks have solutions available which have been proposed and discussed with the National Treasury, and that basis is good to engage in. We haven't reached the time to cap the rates. That's, for me, is a message I would like to send in this kind of conversations with you.
Yes.
That there are avenues to deal with the pockets of the sector where we don't have the best pricing, deal with the risk profiling for customers and determine their pricing, and be able to cut the rates by 100 basis points because the reference rate has already dropped. Those three are good enough, in my view, to drop the rates from the current 18 to around about 15. And that is, and the bill proposes 14.5. Now, Alican, 14.5 and 15 are in the neighborhood of the same range. So I am confident that we have proposals that should be listened to, and those proposals should give us the solution we're looking for lower interest rates.
Now, can I just go back finally to the numbers? You know, double-digit growth you delivered at the 6-month stage. You're painting quite a strong second half picture, so we can expect a little bit of acceleration. These are very, very strong numbers, and also I think the cost of funds is working in your favor as well, coming down. We are, however, in quite an interesting point in the banking sector, in the sense that the central bank governor is not giving any more new licenses. But I would have thought that we must have some external parties looking to enter the market via acquiring one of these banks. And it seems to me that whole process is being encouraged. Is the competitor landscape going to remain as it is? Do you see yourself as being the dominant? I was in the Mara and there was this Notch, the Lion King, which is this enormous lion. When you spoke of the lion, I was thinking of you. Is it? Are you still the Notch in the Mara, as it were, or do you see more competitor threats coming into this region? Because Joshua, you know, when I looked at the IMF, the rest of Africa is really having a problem right now. Commodity countries. We are shining bright, in part because when you compare it, but also because of our own story. Do you see that landscape changing?
I mean, our economy is extremely resilient, and I must say, because we are not very biased to any particular segment or sector of the economy, we tend to perform very strongly on a growth side. We have less impact in terms of global risks or shocks that happens in the economy. You know, so if you look at currency-wise, we've done extremely well. Inflation is well managed. And I would say, yes, so people will be looking in. There's always interest for investors coming into Kenya as a sector. And I would say that, for me, we are open for investors coming into the market in the banking sector. Most of them will use the route of making bids and acquiring existing financial institutions that are here. But we've been, because of the experience and network that we have built in the market and our relationship with our customers over time, that's a very good ring fence point for our business to continue doing better and growing our business. The competition will come, I have no doubt about it. My own view is that Kenya generally as a sector is overbanked. So, and I'm looking at a report which was done a few years ago, and even FSD has looked at this ourselves as a country. Now, 43 banks, now we are down to 42, and 2 of them are in management, so we have 41 banks today. For a population of 46 million is 1 bank per million, correct? So the issue is to build new channels, new technologies, and build that platform to grow services for our customers. But the model of this, if the traditional banking model is becoming more and more difficult. Tanzania has got 58 banks today. We haven't seen a change in that market. And if we are building ourselves to become a financial hub for the region, what we need is to scale up existing enterprises. That scaling question, so if you look at London or Dubai or New York or Singapore, if you look at those markets, especially if I think about New York, if I think about London and Dubai, what they have built is to build fewer and large scalable to address a global market. Our challenge, Alican, is much more a global equation than a regional one. And for that, we do support that central bank and the team is to. So I love the capitalization requirements the minister has proposed. How do you make banks stronger? Give them a bigger platform. If we cannot fund the railway, a $3 billion project, as banks in the industry, then we haven't done much to take opportunity in the market. And through the railway project, we create small businesses. We have the local content added. That, for me, is the opportunity we like to address as a country. So in terms of the market, we will see businesses looking in. I am keen to exploit the International Financial Center that Nairobi is going to set up.
You'd like that idea?
Yeah, to be able to run it, if it is well structured. But again, it will never operate if we control interest rates. Once the market is not operating in a manner that's liberalized, then things like financial center do not operate then. So we're also taking our country back. And finance, technology and investment is one of the biggest knowledge opportunity that we have as a country. We have the skills, we have got the candor, we've got the ethic. So picture us as being a competitor to Dubai or a competitor to London. You need an open market. But my feeling is that is where we need to be pushing as a sector. And we're looking forward to growing our market share as a business. Also,
you were saying you grew the market share in the first 6 months.
So if you look at the central bank report, so we are now up 100 basis points from the same time last year. And that's where our role as a bank is going to be to strengthen and also investing more, Alican, on areas of our sectors. Our foundation today, I'm a strong believer that the role of banks or businesses is not just to create profits and run away with it, is to be able to partner with the communities and make investments with them that are sustainable, lifting people out of poverty, giving them a chance to dignifying their life, give them a chance to be able to say, have better healthcare, better education. So if you look at our Tujajiri program, which we set up early this year, targeting 50,000 young people, the goal of that program is to say, how do we partner and link up with younger people, skill them, build their businesses, grow new entrepreneurs, and grow new businesses for the sector. If those create an additional 1 million jobs in the next 5 years, there you go, your new business. There goes your new market share. There goes dignifying the economy and deepening financial services. This is a time to be able to invest collectively as private sector to build along the Sustainable Development Goals. And that is the role of private sector. We cannot leave that chance of developing our businesses. We can't leave the chance of developing the nation and developing the globe just to the government alone. I believe this is the time for governments to for private sector to put in resources and their plans to champion sustainable development goals. So issues about poverty, access to education, democratization, that is issue that we must address as a business. But I'm happy the KCB already is in the forefront of pushing.
And of course you've got your big TV program, The Lion's Den, coming.
The Lion's Den is more like a culmination of our program to support. And for me, if we see 50 to 100 new entrepreneurs getting access to venture investors or long-term funds, what I will call patient capital, and just challenging the model about running your own business and getting a mentorship and incubation program after, we would have made a dramatic shift in creating the real businesses that will become the globalizers in the next 10 years. So this is an investment for the future. I do believe that some of those will come out, perhaps will be the next billion shillings revenue businesses in the next few years. So it's an exciting space that we're looking at, and I think this is the moment that we want to play for our business.
Two final questions. Joshua, in 2011, when we went to New York and London, I remember you presenting and you were talking about increasing the number of customers and increasing the number of transactions that those customers were doing. This was a core thing of what you were saying then. Now looking at customers have increased incredibly exponentially, more customers last year than probably 99 years of KCB's history. So we can see that happening. What's happening in the product line? You spoke about Islamic banking, I heard, bank assurance. Can you just give us a flavor of what's happening in that continuum of what KCB is offering to its clients, and what's getting you excited?
So for us, our goal was to grow, what you call a cross-sell ratio for our customer. We say let's try and make sure that customers have access to 6 products. So today we are halfway that mark.
3.
So 3 products. And if you look at we look at bank assurance as a service today, we don't see it as a product. We look at our investment advisory as a service, we don't see it as a product. But as we use our technology platform and our mobile especially to basically consolidate our services for our customers, then you get a chance to add on new products. So Sahal Banking and bank assurance has been extremely successful. Bank assurance business grew by 91% on year-on-year basis. Now, you can imagine the opportunity.
So you got platform scale now, really, haven't you? That's what
absolutely.
You've got.
So our goal, and we just started doing the short-term business in bank assurance. We are now going the second half to put in long-term business, which is the real exciting business for insurance. How do you use our customers' network, our network of agents, to be able to ask customers to invest a small amount of money over the long term? How do I put my 10 shillings, 100 shillings every day and get a 20, 25-year investment plan? And for us, you start building the wealth and savings culture for our people. That business, we believe in the next 3 years or 4 years, will be actually 5% of the group business in terms of earnings. It's today anyway the 3rd most profitable business for the group, 4th of the group out of the 7. And this is a business we started in 2013.
Wow.
So Sahal Banking is a new model. We see 100% growth in the last year. It's still in the early stages today.
Is this concentrated geographically in the Muslim parts of East Africa?
Absolutely, absolutely. And today we have also a strong Muslim population in the country. If you look at the numbers, the growth that we have, and also we see more customers who are non-Muslims approaching the bank to take a product or that service because they are more competitive. Sometimes they're seen as more ethical. And sometimes when you're sharing profits, people see that as a much better way for them to do projects that they will never have been able to do by themselves. So those three areas, I would say, and then using our digital services or digital financial services to see payments, so mobile payments, mobile money transfers, mobile loans, so what you call the mobile loans from the KCB, and then using that on the merchant side to say how do we digitize payments, from getting from cash and building a cash-light environment. And that our agents, our merchant business is growing this year by 45% and year on year. So this year will be a record. We actually will take our #1 position on acquiring on merchants this year. Yeah, and that will give you a huge opportunity for us in terms of what we can do. Of course, that market, in the future, we see that changing dramatically from using cards and point of sale. So those are the few things I would say that the bank is very much excited about. So this is a good moment to radically grow into pushing the cross-sell ratio to achieving our overall goal of 6 products.
My final question is, well, firstly, let me congratulate you on these results. I thought they were really strong, in fact. My final question is, are you confident about the East African region? Are you confident about the bank at this moment?
Well, I'm very excited.
Yes.
I've looked across the continent, Northern Africa. I looked at West Africa, especially Nigeria. Looked at Southern Africa, if you focus on South Africa. The only place I've found with collaborations we can exploit as businesses and which gives you a natural hub and commonality about the market is East Africa. And Kenya happens today to be in the center of the network of businesses. Now, there are challenges in terms of how do we move faster to realize the opportunities for the community and also the common market. But in terms of the skill set that we have, the work ethic, the energy and the enthusiasm of our people, and the can-do attitude for our people, I think the road ahead is extremely bright. So sitting together, I'm a very proud East African. And I believe that with the solutions that we have, part of the people for the region have delivered global solutions for the greatest problems. If you think about issues like mobile payments and money transfer, if you think about medical solutions, a lot of our people have all the way been given, some of the younger people today being recognized, in some of the global programs that you see. Some were being awarded by Barack Obama for the work that they have done.
The YALI program.
Yeah, the YALI program. And that, for me, at the end of the day, Alikan, if you have the talent, I believe this team has got the talent and the right attitude for the younger people to exploit. So I see a moment of exponential growth.
Yes.
Something that is more, but it's non-linear.
Yes.
So although we may have been growing at, let's say, 2-3%, I believe that it will be 2 and 5 and 15 and 25.
I like
so
that.
That's how I see East Africa going to grow. So overall, Alikan, we're in the right place. Our business is well positioned, and I am confident that we are creating the right environment that impacts both business and also leaves the opportunities for communities. Thank you very much.
Thank you, Joshua. Thank you very much.
Thank you.